things are starting. Minda Corp is just one thing. There was that block which happened, right? The stock's up 7% right now. So that's a large mover, 400,000 shares on Minda Corp, just to kind of highlight that one as well. Then maybe we could look at Wockhardt, which is up about 6%. Stock's at about 515 coming through right now. Titagarh, we did mention. Quest and NATCO. NATCO is another one. NATCO saw a very large move. Ekta just highlighted, there was a brokerage call, 7% on top of the 10% move on NATCO from Friday. Stocks at 1100. By the way, NATCO is the third largest volume traded name coming through this morning. RVNL is coming up with a 5% pop. Nigel did highlight MRPL with an 11% gain now with tremendous volumes through. Then you got to go down the list to find more names, but volumes are lacking. Sudarshan Chemicals and Rupa, these are all 5% movers. Star Health is coming up with a 4% pop. Idea Forge is up about 5%. But we'll sort of give it some more time to kind of see if volumes are really going to pick up on some of these names. GIC-RE saw a 10% move on Friday. It's seeing a 2% downtick. Dish TV was up 10% on Friday. That's down about 1.5% right now. Wipro was up 5% on Friday. It was a top Nifty gainer. It's down about 1.33% on in terms of trade right now. So that's on the downside. HPL Electric, I think, saw a large 10% move on Friday. That's down about 1.25%. So these are, minor kind of pullbacks coming through after we've had what other moves that we've had. All right, well, more on markets in a bit, but our market master of the day is Sanjiv Prasad. He's Managing Director, Co-Head of Kotak Institutional Equities. Sanjiv, good morning. Great to have you with us here. Last week you put out a note, which was, you guys are known for speaking your minds and writing what you feel in terms of what you think. And there was an interesting play on the greed and fear theme, and the note was titled, "No Fear, Only Greed." So just wanted to start with that in terms of why you wrote that. And second, in that same note, though, you say that nothing negative on the horizon suggests a sharp correction. So how do you square the two, and where does it leave us? If you are looking to deploy money.
Well, it's a tough position to be in if you are a fundamental investor, because on the one side you have stocks which are overvalued, and as we written in the note, the overvaluation increases as you go down the quality curve, the risk curve, the market capitalization curve. So the extent of froth increases, in disproportionate order of the quality of the company, market cap of the company, and so on and so forth. But having said that, this could well continue. You could see a big disconnect between price and value, which is the case currently, continuing for a long period of time. For the simple reason, we don't see anything negative on the horizon, which can result in a big correction in the market. If you look at the macroeconomic fundamentals of India, pretty strong. Growth is obviously pretty decent, and some of the other macroeconomic parameters which people have worried about historically, such as inflation, current account fiscal deficit, slightly on the weaker side, but clearly improving. If you look at the political setup, it looks like the BJP is going to come back to power. At least that's what the market has decided. So no negative news likely from that side. Global setup also looks pretty reasonable. At some point in time, the US Fed and other central banks will start cutting rates. So that should again provide some tailwind for the Indian market. And lastly, if you look at the position as far as Indian companies, household, government, etc. is concerned, there is nothing negative out there in terms of over leverage in the system, which should be a warning bell or something like that. So that's the lay of the land. On the one side you have a pretty decent macroeconomic setup. On the other side you have very expensive valuations. So I guess we'll have to just live with the two. In the sense, you'll have some amount of discomfort with respect to valuations, but I guess we'll have to just live with that.
Okay, that's a big statement, right? You're saying you don't see anything negative on the horizon that can result in a big sell-off in the market. And that's
barring the valuations.
Barring the valuations, of course. That seems to be everyone's concern, right? It's very, very hard to find value even in individual sectors now. So what do you do, Sanjiv? If you have an optimistic view on the market and you want to continue to deploy money, which are the areas where you have some glimmer of hope that, okay, here you have both valuation and growth?
So, then you'll have to look at, individual pockets, more sector by sector, stock by stock. So thankfully, as of now, you have one large sector, which is the financial sector, where at least valuations look a lot more reasonable. And here the valuations are reasonable for the for most of the names, whether you look at the large cap private banks, look at the PSUs, although they have run up quite a lot in the last few weeks, months, but at least, you can get your head around the valuations over here. Most of the, the better quality large cap private banks are in the low twos, one time forward price to book. If you look at the better quality PSU banks, now they are more like 1.2 to 1.4 times one time price to book. So, doesn't look that crazy, compared to historical levels. Yes, some of the public sector banks may be looking on the higher side, but having said that, their credit quality, etc., is far better than what we have seen in the past. Underwriting practice have improved, so I don't see anything negative out there. And then beyond the financial sector, I guess you'll have to just look at individual pockets where, like, for example, consumers, staples are discretionary. Obviously, you have a lot of struggle as far as growth is concerned. But hopefully our view is that over the next 2-4 quarters, you start seeing some pickup in volume numbers. If you look at the valuations over there, maybe 10-20% overvalued in some cases, but at least I can live with them. In the sense they're good quality companies, generate a lot of free cash flow, high return businesses. Yeah. So okay. Similarly, pharma, healthcare services, again slightly on the expensive side, but again very good long-term businesses, so we can live with that. So the challenges beyond these pockets, of let's say financials, some consumers, and pharma, healthcare. Beyond that, become a bit of a struggle. IT is looking expensive. The investment space looks very expensive, although the news flow there will be good, looks like. And as I was saying earlier, beyond that, if you look at the low-quality names, some of the mid-cap, small-caps, they have been a tear, absolutely. Many of them are up 300-500% last, year or so without really any major change in the fundamentals. So I don't know how to deal with that part of the market. So we will probably just, exclude that bucket for now, just focus on the large cap names where you can find at least some value and stick with that.
All right. Hi, Sanjiv. Good morning and good to hear your thoughts. Sanjiv, what do you do with this entire frenzy in the PSU names? I'm just looking at a few of these railway themes. They're just flying away. RVNL, IRFC. And mind you, these stocks are already up 3 or 4 times, in the last 18 months. What would you do with these PSU names? If you have them, would you book out? And is there anything that you see that looks interesting to buy from the PSU basket at these levels?
Nothing really, if you just want to stay invested in some of the PSUs, as I was saying, PSU banks are the ones where at least, you have some, valuation comfort. Something like an SBI is about 1.4 times one-year price, one-year forward price to book. If you look at Canara Bob, about 1.2, 1.3. So at least you have some comfort over there. But beyond the PSU banks, absolutely no comfort on the valuations. And keep in mind the fact that it's not as if there's a big change in the fundamentals of many of these companies. For example, if you look at BPCL, HPCL, yes, they are making record marketing margins as of now. But that is only valid up to a point where the government allows them to make this kind of marketing margins, or if or crude prices continue to be at lower levels. The moment crude prices go up, obviously the marketing margins will come down. So, investors are willing to take a call that their marketing margins will be high in perpetuity. I'm no longer, not very sure about that. Right? How do you get comfort on that kind of a thesis? The railway stocks you mentioned, absolutely no comfort over there, given the fact there's a big disconnect in terms of their fundamentals and the kind of valuation they're trading at. Many of them are at, some absurd valuations of 50, 60, 70p. I don't know what sense it makes. In one of the interviews, we had talked about Indian Railway Finance, Corp. I mean, that company is now trading at more than $20 billion market cap. Something like 5 times price to book. I don't know how you justify the valuations of some of these entities now. It has got, by the way, got less than 50 employees here. It's a struggle trying to get your hand around many of these companies now.
No, absolutely. Point taken, Sanjiv. So one of the things, right, which comes as sometimes as a bit of a pushback to these what could be unsustainably high valuations, is that we are in a moment where there's a huge financialization happening, right? Domestic savings are coming into the market in a very large way, and that flow is not going to go back easily. It perhaps will keep rising steadily. How big of but there's no. I mean, how do you model something like that into valuations and what people are willing to pay for it? Because when mutual funds get money, they will deploy it. They may be uncomfortable, but it'll go in. Yeah. So just your thoughts.
No, I agree. It's a very uncomfortable position for even the fund manager, right? You continue to get money. What option do you have but to deploy, as you rightly said? If you look at the amount of fund flow which is coming in last month, that is January 2024, you had almost 30,000 crores of money coming into domestic equity mutual fund, which is at record levels clearly. The monthly SIP rate has now gone up to something like 180 billion rupees, which is more like $2 billion plus kind of a number. So, obviously the fund managers have to deploy, but, I just hope, we are not losing sight of the bigger purpose over here, which is ultimately to, act as fiduciaries for the people who are giving them the money, right? It cannot be a situation that just because they're getting money, we'll continue to deploy irrespective of valuation, irrespective of the fact whether this, valuation make any sense or not, whether the fundamentals of this company is, correspond to the valuation they're trading at. Somewhere, some of the active fund managers will have to start taking the call and start, at least gently educating the people that, look, fine, you're giving us money, it's our duty to deploy, but, be careful as to what you're getting into. I don't really hear that commentary from any part of the market as of now.
Mm-hmm. Okay, one final question then from my end before we let you go. I understand that there is no real threat in the market right now. Everything seems to be going well, but that is generally when the market doesn't oblige, right? Apart from valuations, is there any other concern that you have that the market should sort of keep on its radar?
Not really, as I said, it could be my famous last words for all nothing negative and then something boom, something goes wrong. Hopefully that will not be the case, because as I said, it's hard to, identify a cause for a market correction before the event actually, and this time around, if you look at the situation, there's nothing really negative with the Indian economy. It's doing absolutely fine, as I was saying earlier, all the macroeconomic parameters are in great shape. The political setup is fine, social setup is fine, leverage is not really a problem when it comes to corporate, government or household. So I don't know what is the trigger over here, barring some extraneous event, like war, pandemic, anyway, we can't forecast that, and I hope nothing like that happens anyway. Very hard to say what will result in a correction. All I can say at this point in time, you'll have to just live with the discomfort which we are in, high valuations, but yeah, it probably, that's the lay of the land, and probably it will continue like that for some more time.
Well, always good hearing your thoughts, Sanjiv. Thanks so much for stopping by and speaking to us here on CNBC-TV18.
My pleasure.
Looking forward to having a chat with you in the time to come. Well, time to move on then, and let's get to a CNBC-TV18 exclusive then. NALCO reported a solid set of numbers in the past quarter. The result was driven by lower power cost and also good operating performance in both their segments, alumina as well as aluminium. To discuss this and more, we have Mr. Sridhar Patra, the CMD of NALCO, who joins us on the show. Hi, Mr. Patra. Good morning and good to speak to you after a very, very long, the analyst community as well is waiting to hear you out. So we are happy to have you on the show. Well, let's talk about the past quarter's performance. It's looking absolutely superb. Blended margins coming at around 23%, the highest we've seen in the last 6-7 quarters. So give us a couple of numbers here. One is on the power cost side, you've saved quite a lot of costs, which is good. Tell us, out of your total coal requirement, how much of it is coming in from captive sources, and how do you see that scale up, and what does it mean in terms of margins?
You see, for our 0.46 million ton of smelter as in existence, almost 67 to 70 lakhs coal is required for production per annum. And we are fortunate, we have ramped up the production of Utkal D and E, and normally any mines which comes for operation 15 to 18 months, but within 6-7 months we could make it operationalized, and we have ramped up the production. In the current financial year, we will be producing 2 million ton from our own mines. And the next year we have a plan to make it 4 million tons. And as for the provisions, 25% we can produce more also. So it is a efforts made to maximize our own coal consumption from our captive mines. So this year we have planned 2 million tons. Next year we have planned 4 million tons.
Just to get those numbers out of the way, sir, 6.8 million tons is the requirement. For FY24, you're getting 2 million tons from your captive mines, right?
Yes.
And for the next year, it will be 4 million tons. So that's FY25 itself. So, good amount of captive coal that's coming in there, which obviously helps in a power-intensive sector like aluminium. Give us a few more details. What does this mean on margin outlook? Because prices seem to have bottomed out, both on aluminium as well as alumina. And we're seeing a mild uptick January as well as February. What is the guidance over there, and what does it mean in terms of margins?
if you want to speak about the margin, these are the price sensitive. Basically, I will not spell out the exact figures, but I will tell you, if you see the LME price hovering around 2000 to 2100 since last 9 to 10 months. In 22-23, the LME average price was 2520, but in the current 9 months, it is average 2200. And if you analyze quarter to quarter, in the quarter 2, it was around 2155, and quarter 3, it is around 2190. It is marginally increased. And we are quite hopeful that in the quarter 4 of the current fiscal, we will be getting above 2200. So on an average, it will be above 2100. This is my expectation of price for the current fiscal with reference to the aluminium. And so far alumina is concerned, basically it is 15 to 17% of the LME price. So it ranges between $330 to $370, $380. It is coupled with supply and demand forces. Basically,
yeah, Mr. Patra, just to come back to that, you said aluminum LME prices, you're expecting it to be above 2100 per ton going ahead. But, you know, recently we've had some issues, right, with respect to the Red Sea conflict, etc. Has that impacted prices in any way?
You see, basically the market-driven forces, we cannot say whether it is impacted or not impacted. If you analyze for the whole year as a one financial year result, then it will have a mixed impact. The input prices increases, again it reduces, and sometimes the LME increases and reduces. So it is a question of whole year data will speak.
All right, Mr. Patra, hi, good morning. Prashant this side. So, two questions. One, so in FY25, over 50% of your coal requirement will be captive, as you said. So that is pretty significant. So generally, I mean, in terms of cost competitiveness, I'm assuming that that's a big boost. If you could just sort of answer that. And second, when do you expect an additional 1 million tons of alumina capacity to come on stream, sir? And what is the capex needed for this?
Two things I will tell. The captive coal mines, which you have mined out at present, and we are made operational much before the scheduled time, and we are quite hopeful it will give substantially to the bottom line. Because basically the raising cost and versus the price at which we buy, whether it is e-auction or linkage coal, whatever may be, there is a huge price difference. So definitely it will add back and it strengthen to my bottom line. And so far 1 million ton refinery is concerned, we are quite hopeful by 2025-26 mid, it will be capitalized. And the capex investment for this is around 8,000 crores. And the company is confident to fund its resources from its internal accruing. And if required, we will take the loan. But for the time being, we have not availed any loan.
Okay. And what is the cash balance as of now? 3,900 crores?
Yeah.
3,900, right?
Somewhere around that.
Got it. And per ton of coal, how much do you save? You said it's substantially low. How much is it?
You see, 667 rupees we are giving to the MDO for raising the coal. And other taxes and duty put together, it will be much lower than the cost at what I am buying either linkage or bridge linkage.
You want to give us a number, sir? 1,000 rupees, 500 rupees, 1,500 rupees, what could it be?
Exact number I will not be communicating.
We are okay with the range, sir. A range. A rough range, Mr. Patra, if you could give us. Per ton of coal, how much are you saving?
Coal, I told you, we will be using 2 million tons.
That's right, sir. On a per ton basis, how much are you saving? You know, I just want to get a rough number out.
No, those are price sensitive. I cannot pass on how much I will save.
Okay, all right. We'll let you go on that one. But, you know, your alumina expansion as well, you've given us a guideline by FY26. So we got that. Mr. Patra, one more question. I need to ask you this because, you know, some part of the street is expecting maybe there could be a divestment of NALCO. Do you want to clear the air? Have you heard anything from Deepam, whether NALCO is on the block or not?
No, I have not received any formal communication, or informally also I have not gathered any information.
So there's no truth over there, right?
Hope so.
You're keeping it open-ended, sir. But you haven't heard from now, so we'll take that. But there are some diversification plans as well. You know, there was that JV that you're a part of with regard to lithium mining as well. So could you tell us what is 8,000 crores is for the alumina expansion? For this diversification plan with regard to some rare minerals, how much of money are you all keeping? And by when do you see some kind of returns coming out of there?
You see, we have various business plans. Now the company has also promoted Kabil, and we have signed the agreement with the Argentina government for lithium extractions. And we are also having downstream plans. And we have also business plan for expansion of these smelters. So various diversification business plans are there. And we are also seriously thinking for the merchant mining. So we are trying to explore. If you win in the auction, we'll definitely go for merchant mining, which will add also profit.
But no concrete plans as of now. You're looking at diversification, but that will flow, I guess, in the next 3-4 years or.
If you ask me, basically it is a dynamic situation. Every time the scenario changes. So as such, we have a plan for expansion of this alumina refinery, which is in progress. And the smelter plant also will be expanded. The investment approval has been accorded and land acquisition is under process. So these are two the basic business model, and the intention of this is to support throughout the life of the company to earn profit. So diversification what will make without compromising with the intent and ethics of the business. Our intention is to provide primary metals to the secondary industries. There are two differences. One is business, one is industry. The businessman will look forward the profit, but as an industry, we want to grow the economy, because our secondary industry, whom we have assured raw material securitization, we want they should grow. It is not at the cost of them we want to grow. So we want to contribute to the national economy, not standing alone by NALCO along with the other tertiary industries.
Okay, all right. Final question, sir. Dividend has been another juicy topic, you know, because you all have been giving out dividend and the shareholders are very happy. What's the dividend policy over there? Will you continue to pay out? I think already this year you paid 1 and 2 rupees.
As a public sector undertaking, we are bound to follow the DIPAM guidelines. And as per the guidelines, 30% of the profit or 5% of the net worth, whichever is higher, is to be paid dividend. And the company has been paying higher than that dividend, and we assure all our investors will not disappoint them.
Okay. All right, Mr. Patra, always a pleasure speaking to you, sir. Thanks so much for speaking to us here on CNBC-TV18. You give us the outlook in terms of aluminium prices. Coal, nearly around more than 60% will be coming from your captive mines, which will result in saving, clearing in the air that the company is not on the block, and you look to pay out dividends as well. Always a pleasure talking to you, sir. To speak to us more often, we'll be happy to host you on the show.
Well, you know, Mr. Patra, thank you very much from all of us here. Appreciate you joining in. PSUs, right? NALCO, we were talking about public sector, but it's again come back right on top as the top theme this morning, right? So we were talking about only MRPL, but take a look at what else is going on. MRPL is up a little bit more, 14%. But I just want to put out these stocks. NHPC is now the top volume-led gainer. It's up 6%. There is RVNL nowhere in the mix in the morning when we opened. 7% on RVNL, 268, 269. SJVN is up 5%. So, yeah, I mean, once again, these are strong movers which are coming through. And a few other non-PSU names. Reddington is up about 10%. That's a large mover. Sundaram Finance is up about 6%. 4,090 on Sundaram Finance. Inox Wind, I mean, a tremendous 2024 so far for the company, for the stock, 5%. And CRISIL, out of the blue, is up about 8% or so as well. So this is a strong-looking screen. Market breadth is pretty positive in the vicinity of almost 3:1. We'll take a quick commercial break here. We have the management of Glenmark Pharma joining in to talk about their third quarter numbers and F525 outlook as well. Stay with us.
Welcome back. Well, it's not a bad market. I mean, it's absolutely flat if you look at the headline index, but the mid-caps are doing very well. So up about 190 odd points on the mid-cap index. Many stocks are sitting at fresh highs. Today, we were just talking about a few of them. Inox Wind is at a fresh high now. It's up 25% this year already. The big theme has been renewable energy in the last couple of weeks and months, and Inox Wind is one of them that has, sort of reduced its losses, and now the stock is doing extremely well. But Glenmark Pharma is the next management in focus. The company has reported a weak set of Q3 numbers. The revenue slipped nearly 28%, but the company in its conference call indicated that they will be net cash positive this year and will see recovery in the India business in Q4. V.S. Mani, who is the Executive Director and Global CFO of Glenmark Pharma, joins us now to talk about that. Mr. Mani, thanks a lot for joining us. I understand that this is a transition quarter for the company, so there has been a bit of, a degrowth as far as the top line is concerned. But can you guide us more on what's happening with the India business? The distribution model has changed this quarter, so that has impacted the business. And what are you expecting going forward? When do you see growth return?
Good morning. Thanks for inviting me to your channel. So basically, the company implemented changes in its distribution model, and we actually consolidated our stock points. Okay, and this led to basically channel correction. The inventories in the channel, and this is basically a one-time correction. Okay, if it were not for this correction, our growth would have been almost 9% for the quarter. And as you can see, even IQVIA reported that for October to December, Glenmark grew at about 11.9%. So the growth in the secondary market has been pretty healthy. Okay. So the advantage of doing this correction has been that basically it will help us to improve our working capital, at the same time improve our margins. Also, in future, the secondary sales and the reported numbers will be close to each other. And all in all, we felt that this was key to do. And that's why the company did this. But barring this, the underlying growth has been pretty good.
But I just want to understand on the operational front, right? This time there was a big EBITDA loss of about 200 odd crores. By when do you think you can get into the black on the operational front? Will it happen in this financial year itself?
Yeah, it will happen in the next quarter itself. I mean, barring this, if we were to have actually not done this correction, we would still have been in the, we would have been in the black. So this is the first time in a long time we are there. But barring that, we would have been positive. Okay, so that's how we look at it.
Mr. Mani, hi, good morning. So beyond this, the quarter that we are in, for FY25, sir, what should we expect, sir, in terms of growth, both in the India business and in the US business as well? I mean, the last time we spoke, you'd put out some guidance for the US business. So if you could just sort of talk to us about FY25.
So obviously, I'll try to guide you on the sales side. The rest we'll probably wait for the Q4 to get over in terms of EBITDA, etc. Just to guide you, the India business, normally in a good quarter, we have anywhere close to 1,100 crores as turnover. So I think going forward, that is the trajectory we'll see it at. And even if you take our secondary sales or historically, we've always grown at close to 10 to 12%. So that growth will always be there. And coming to the overall company growth for the next year, I think we are again looking at about a growth of almost 10 to 12% on an overall basis, because some of our geographies like Europe, emerging markets, they've all done very well. Now, coming back to the US, as you can see, emerging markets have grown at almost 18 to 20% in the first 9 months. Europe has grown at an astounding rate of close to 50%. So these have been very good growths. And as I explained to you earlier, if it were not for this one-time impact, India would also have seen a very good growth. US, obviously, the last couple of quarters, we have not had any significant launches. Okay, so because of that, as well as obviously the price erosion has come off, because of these two factors, the turnover is at about 92 million or so. And this quarter, of course, we have launched a couple of injectables, which we are hopeful that they will give meaningful sales in the coming quarters. So we are hoping to touch close to 100 million going forward in the US.
So as
far as the margins are concerned, obviously in the coming year, we see improvements because of one, obviously, as we had explained during our call as well, on the innovation side, because of all the changes that we have made and the alliance that we have, we are expecting a sort of reduction in our expenses by about $25 to $30 million. as well as Realtor is doing well, and also my expansion in geographies of Europe and Latin. So I think that's how we see the coming year.
So a top line growth of 10 to 12%, margins between 18-20%.
Margins, I mean, as I told you, it will grow better than where we are in terms of. But to put a number, we'll probably wait for the Q4 to get.
Okay, all right. Hi, Mr. Money. Good morning and good to have you on the show. Sir, your operational performance, you've given us a fair idea. $100 million in the US business on a quarterly basis. I think India goes back to 1,100 crores. But over the weekend, a couple of my colleagues were working on the story that it's a possibility that Novartis could be on the block. How does, would you all look at it first of all? And do you think there are any kind of synergies that could play out between you all? If it's on the block, I would like to know, what are your thoughts?
No, we are not really looking at any significant M&A right away. We have been actually, we have been, in a way, in licensing products that you saw, some of those that we saw, the envafolimab, and there was a product, Winlevi. So these are products we in-license, but we haven't looked at M&A in such a big
Have you heard about the asset being on the block though, sir?
No, sir, we are not really so much keen.
If it's on the block, are you all interested?
No, I wouldn't know.
You would not be, because there would be some kind of overlap. There would be, it could bring something to the table. So if it's on the block, you all would still not be interested?
No, sir, we are not really looking at. We are looking more at what critical product additions, platforms that will help us to grow our business. As such, if you look at it, Glenmark has been doing well. We have got good growth across all the geographies. We're doing well. I mean, barring some things in the US where we are also working on correcting where we are. I think broadly the business is doing well. So I don't see a reason why we should immediately.
Okay, can you give us? Sure. Thank you. Thank you for that clarification. Can you give us an update on the US FDA, regulatory issues? When can we expect some remediation to be completed? If you can tell us when is the re-inspection happening across all of your plants, right? Whether it's Goa, Baddi, the Monroe facility. Can you give us a status check on that?
So as far as the remediation is concerned, I think broadly we are done with everything. I mean, nothing significant that we expect in the coming quarters. Even this quarter, it was not so much. We are hopeful that an inspection will happen in Q4 or Q1 and we'll see some, uptick in the Monroe facility.
By when? On the Monroe facility?
By Q4, by the coming, that is this quarter, obviously, there's just 1.5 months left, or in Q1 of FY25, one of the two.
Okay. And in terms of Ryaltris, the respiratory drug, I just want to understand what is the way forward? What are you expecting in terms of from this drug as well as from other new launches in this space itself?
So Ryaltris has been doing pretty well, madam. We have launched it across many geographies. As you can see, currently it's almost like a $45 million product. We're looking at almost like a $75 to $80 million in the coming year. Now it's obviously we've been selling through partners as well as through geographies where we have field force. I think it's doing quite well in Europe and beginning to pick up well in the US as well. So we are hopeful, that also our partner in China will support the whole thing. So I think overall we are looking at a good coming year for us. And as far as the other product launches in the respiratory side are concerned, they actually obviously you can see some of them are done well in Europe, and going forward, whatever launches we are looking at, I think they will do pretty well.
Okay, Mr. Mani, we'll leave it there, sir. Thank you very much, and it's always good speaking with you after the quarter numbers. And we look forward to future interactions as well. Thanks very much for joining us. The market's down 3 points, so the gains are gone, and we are absolutely flatlined. 22,040 is where we are at. We'll take another quick commercial break here. We are back with more on the others. Okay, I think we have the management of Titagarh Rail Systems joining us right now. Najee, do you want to take us through that?
All right. Well, let's go straight to it then. Titagarh Rail Systems is surging in trade after receiving an order worth 170 crore rupees to supply 250 specialized wagons to the Defence Ministry. To discuss the business opportunity and more, we have Mr. Umesh Chaudhary, the Vice Chairman and MD of the company. Hi, Mr. Chaudhary. Good speaking to you, sir. And this big opportunity is coming into play now. Could you tell us more about this particular order that you've got of around 170 crores? And also, if you could tell us, how much does Defence currently contribute to your sales mix? And where do you see that number headed?
Yeah, good morning. Always a pleasure being with you. Thank you for inviting me. So this is a very important order for us, because this is for of course, it's for the freight rail system business. is for specialized wagons, but it's from the Ministry of Defense. We have done similar wagons for the Ministry of Defense in the past. And, so this business, while it is from the Ministry of Defense, would actually get counted in our freight rail system business itself. In terms of the overall size of the business from the defense side, we are primarily focusing on the naval part of it, the shipbuilding part of it. And I think last what we declared was about 400 odd crores of orders that we had from ballpark of that from the Navy. As we had mentioned in the past that, right now, because of the traction that we have from the railway part of the business, we are really focusing on that part right now. And defense is something that we are keeping it as the additional lever, which we have announced to, if required, look for a strategic partner to grow that business as well. But right now, the focus is primarily on the railway part.
Okay, so just to revise that number, how much is it contributing now in percentage terms?
So the total order book that we had announced was about 28,000 crores. So this is about 400 crores. So it's not a very significant
400 crores.
Number. Yeah.
Okay, all right. Can you tell us, defense, how much does it contribute to your sales at the moment? What is the kind of potential that you see in the defense space, say, over the next 12 to 18 months?
So defense is not a very large part of our business right now. As I just mentioned that about out of 28,000 crores, the defense business would be hardly about 350 to 400 crores. And the similar is the story as far as the revenue or the profitability is concerned. But what we do see is that the defense can be a very significant part, maybe 3-4 years from now. So we are kind of keeping this as the reserve engine for growth. Because the two engines that we have, the passenger rail side and the freight rail side, are really firing full gun. So we are focusing on that and kind of utilizing that to grow at this point of time. And the defense will really be the third engine of growth that will come in post that. And we are continuing to kind of keep that on slow fire right now.
So can you tell us what is a new order bidding pipeline? What kind of opportunities do you see across the board, right? Whether it is orders from the government, private sector orders, what can we expect over the next 12 to 18 months?
So the railway side of it is really, there are new opportunities that are coming up on a regular basis. There is a very good traction that's happening. Of course, we will see some slowdown in the next couple of months because the model code of conduct, when that comes in, then obviously the public procurement slows down. But then, post that, I think we are going to come back with a real bang, hopefully, and the infrastructure spend that is likely to be there is hopefully going to be of a different magnitude altogether. With the new Viksit Bharat and India looking at becoming the third largest economy in the world, the infrastructure boost is going to be quite substantive. So, there are a number of tenders that we have participated, number of tenders that have been issued, both in the freight side, both in the passenger side. But we would definitely talk about them once, as and when we kind of successfully win some contracts. We'd not like to talk about them prematurely. Okay,
got it. All right. Sir, if you could give us a few more details. Currently, you're going at a run rate of close to around 1,000 crores per quarter, very roughly. How do you see growth shape up from here on this base of what you're going to do in FY24? What is the growth you look at?
So, if you look at the mix of the two business segments that we have right now, majority, almost 90% plus of our revenue comes, or approximately 90% comes from the freight rail side. And passenger is a business that is just going to pick up, whereas the order book, if you look, is almost equally divided between the freight and the passenger side. So on the passenger side, so while on the freight side, we will be, as we had announced, we've already touched 1,000 wagons a month in December. So we've kind of broken the glass ceiling, broken the mental barrier. Now the next target is to stabilize from the 700, 750 wagons per month average level to 1,000 wagons per month average level, which we should be able to do in the coming financial year. And then the passenger side starts delivering revenue both on top line and bottom line. And that would happen in the later part of FY25, because that's when the Surat, Ahmedabad and Vande Bharat will start into production. The first train, of course, of Vande Bharat is likely to be delivered in June 25. So, that is going to be the big turning point for the passenger side when the Vande Bharat.
Okay, so once that happens, what will the contribution be for your revenues purely from Vande Bharat in year 1 and year 2?
So according to the contract, we have to deliver the first 2 trains in June and August 2025, and thereafter it will gradually ramp up to approximately 2+ trains per month, which will, I think, if my memory serves me correct, will be in about a year, 16 months time that we will hit that run rate. So it's going to be a gradual ramp up from June 25.
Okay. All right. Final question, sir. You said there's a possibility you look at bringing in some kind of strategic partner in the defense vertical. At what scale would you look at bringing, someone in? And also, what is the time horizon for this?
We had announced this a couple of months ago that the board has decided that we'll be looking at this possibility. We are working on it. It will take a little while, but maybe in the next 6 months to 12 months. So there's no kind of definitive timeline that we have put to it, but there's something that we are exploring.
Okay, Mr. Chaudhary, good speaking to you as always. You're speeding ahead, so to call it. Stock market as well as liking it with regard to the announcements you've made. And as we speak, the stock is up close to around 5%. We look forward to having a chat with you in the coming weeks as well. For the time being, though, we'll slip into a short break. You come back, the markets are as flat as can be. Prakash Gopal join us to give us some trading strategies.
Welcome back to Bazaar Morning Call. Well, for now, let's get a quick update on what's happening in the technicals of the market. Prakash Gaba is joining in. Prakash, the market is all right. I mean, it's holding on to the 22,000 mark, just consolidating for now. Would you build on to these gains, and what are the stocks that you're looking at right now?
Yeah, good morning to you. So far, Nifty and Bank Nifty both look okay. The problem with Nifty is that it's open with a gap up, and open and high is the same, so that's why it's into a resistance zone. The resistance zone is 22,000 to 22,100. It's open there. So there's a bit of struggle there for a trading opportunity. Otherwise, the trend is still intact up. We are in buy mode. If we get a dips, we are buyable. But where to buy, where to sell is an issue on Nifty, so I'll avoid it. Bank Nifty, again, I would say that 46,500, 46,400, actually 46,400 is a very strong support zone. As long as it stays about it, I think an upside to 46,700 to 47,200. That zone is possible. But for that, the trade has to be between today and tomorrow or day after. So far, it's some viable dips. What do I like? Well, I think I would look at few stocks here. One is Bajaj Finance. That looks good to me. Has formed a good base for on 10 to 12 days. And trading at 6,717. 671, 17. I would have a stop below 6,700 and trade long. Possibly the next technical target is 6,800 in the days to come. So Bajaj Finance looks good to me. It looks like today is the day for Bajaj Group. Second stock that I like is, I think I would look at perhaps Dixon Technology. Yes, trading at 6,527. I would have a stop below 6,500, again 27 rupees. Possibly up move is there on the cards, and 6,600 would be the target. So two stocks here, Bajaj Finance and Dixon.
All right, Bajaj Finance and Dixon. Prakash, thanks very much for that. We'll have more in a bit with Prakash. Well, markets absolutely flatlined. It's like a red and green blinking. Focus on commodities. Manisha is here with what's the top commodity on our mind today. Manisha, morning.
Morning, Prashant. Thank you for that. Well, I'm looking at the rubber prices, which are trading at a 5-week highs. Well, there are various supportive factors which are keeping the rubber prices in favor. One is that there is strong demand improvement coming in from the auto and the tire manufacturers there. Also, when you look at the supply concerns that have been erupting from various producers within the Asian markets, especially Thailand, where we have seen recent rains disrupting supplies there. And then the EU deforestation matter is something that the markets are keeping a keen eye on. It also has to do with the Red Sea impact, where you have seen disruption within the routes, and also higher times, free trades, unavailability of containers. Those are some of the factors that also are keeping the prices higher. If you look at the global markets, then it is also about the EV demand, which the street is keeping an eye on. These are the numbers really, because in 2023 January, you saw 660,000 units being sold when it comes to new EV sales. For Jan 2024, it has been almost a double number at 1.1 million units there. Keep an eye also on in sense of the deficit in the global markets there, and the global rubber production, when you look at that, has been slightly on the weaker side. The international markets have been in deficit since 2021, and 24 could be no different. Production in 24 is estimated at around 15.05 million tons, while consumption is anticipated much higher at 15.52 million. And remember, we are in a deficit, and this is going to be a fourth straight year of deficit as far as rubber availability is concerned. Keep an eye also in the Indian rubber markets, and this is the production and the consumption numbers that you have seen in last few years there. So while the production has been increasing, but at a very small note, the consumption clearly has been jumping with leaps and bounds. The markets do believe that last year, while the rubber prices were quite flat, but this year you could be looking at surge continuing in for those prices.
All right, Manisha, thanks a lot for that. So let's now get back to tracking the equity markets. Vivek is joining in to tell us about L&T and why he's watching that one. Vivek, over to you.
Well, good morning. That's right. It's a bit of an important development as far as L&T is concerned. Now, newspaper reports are indicating that Saudi Aramco, which actually had significant capex plans in order to go ahead and upgrade some of the major refineries and also go ahead and do capex expansion in terms of capacity build-up, it now appears as though they have gone ahead and deferred some of the important projects that they had in the pipeline. In fact, the reports indicate that Saudi Aramco has deferred the bid process for over $10 billion worth of orders, and this is for the large Safaniya oilfield project. Reports earlier had indicated that L&T, number one, had participated in the tender, and also had reported that L&T was favorably well placed to get bids as large as $5 billion. So now this particular development that indicates that there is a deferment of the entire process is something that will be seen as a bit of a setback to L&T. Now, it is important to note that L&T, had told us post Q3 that they had participated in the tender, but they were still awaiting feedback in terms of, whether the bid, they had won the bid. So this particular bid is not part of the order book that L&T already carries. But it's a bit of a negative setback given the fact that it indicates that the large hydrocarbon segment ordering activity that was extremely robust so far, this particular development indicates that there could be a slowdown over there. We reached out to L&T today. So far, they have not yet responded to us.
All right. Vivek, thank you very much for that. Stock's down about 1% or so, but that's important news flow in terms of future orders, which perhaps were, L&T is as good a company to be able to win some of those projects as any globally, and some of them being deferred for now. So that's essentially what's coming through. Vivek getting us that story. We'll take a quick commercial break here, but we're going to be back. My colleague Lata will get chatting with Chetan Iyer, Chief Asia Economist at Morgan Stanley, and the Decode US Consumer Price and Producer Price data on the other side. Stay tuned.
Hello and welcome to this special Indianomics, where we are looking at the goings-on in the two largest economies, US and China, and their impact on Asia and India. The US first, the consumer price and the producer price data have shocked financial markets. While the US January CPI number came in at 3.1 year-on-year versus market expectation of 2.9, the producer price inflation was worse. That is, it is their wholesale price inflation. It rose by 0.3% month-on-month versus market expectation of just 0.1%. This is the highest rise since 1 year ago. So, does the Fed remain tight for a longer period than the market anticipated? On the other hand, when we come to China, there is a growing fear that China is gaining more market share globally and is cutting prices aggressively, creating a deflationary force. Now, how will all this impact emerging markets like India? An inflationary force in the US and a deflationary one in China. I have with me perhaps the best in the business, Chetan Ahir, the chief Asia economist of Morgan Stanley. Chetan, thank you very much for joining me. Well, first up, let's just look at the US numbers by itself. What is the Morgan Stanley reading? Are we going to see the US push back, the Fed push back interest rates? Do we get cuts even in June, which is where the market seems to be expecting?
So, Lata, we actually were already forecasting that US inflation will sequentially go up in the first quarter. And actually, the numbers were even surprising to us. So this is definitely a factor that will hold the Fed back from the earlier rate cuts that markets were pricing in. We have been at June rate cut, and we maintain that. And we still think that the Fed will be able to cut rates in June because we're expecting that sequential inflation will begin to narrow again or decline again from the second quarter of this year. And at the same time, we're expecting that the job prints will also begin to slow. There is some residual seasonality that affects the numbers for January, and we think that January numbers were definitely bumped out a bit too much. But going forward, jobs prints will also slow. And so the combination of that sequential slowdown in inflation as well as job slowdown will allow the Fed to go ahead with a rate cut in from June of this year.
Okay, but actually we have spent all of 2023 expecting the US to slow down and the Fed to cut. Actually, every quarter the US GDP numbers have been higher than expected. Global GDP for 2023 has been higher than expected. India's GDP for 2023 has been higher than expected. What are the chances that 24 also we see slowdown, but we're going to spend the year getting surprised with data on the upside?
Yeah, of course, there is a possibility on that, Lata. The way we would sort of highlight is if you look at the jobs trend, there is definitely a trend which is showing you that job prints are coming down. We get bumps up in a month or so, but on an average, job prints have been slowing. And that's what matters for the Fed more than GDP growth. And as far as inflation is concerned, similarly, we've been seeing that inflation prints have been coming in line in terms of deceleration. In fact, just before this month, CPI prints were actually surprising on the downside. So we think that, if you look at the trend, not just one data point, as the Fed would like to call it, the totality of the data, I think it is still very much, our base case is very much intact, that Fed will begin cutting rates from June.
Okay. Now let me come to the other part of the US. The fisc, the October, November, December fiscal borrowing indicated that, if you multiply it by 4, then it indicates that the US may run a pretty high fiscal deficit this year as well. 8.6% is what one economist calculated. If that is the case, even if the Fed were to cut, will we see too much of fall, especially in long tenor bonds, because the Fed is going to, the Treasury is going to keep issuing them. What's the view on the longer term yields?
So ultimately, it will be, of course, the long-term yields will be driven by what is the Fed's guidance on the short-term rate path. And right now, markets have obviously run ahead and begun to discount rate cuts from March, and that's been pulled back, which has pulled the 10-year bond yields also higher. But from a deficit outlook perspective, we are expecting deficit to be at 6.1%. There is a bill that is pending in the for Senate's approval. If that gets done, that's a tax reduction bill. That will be taking deficit estimates to 6.5%. But so call it 6 to 6.5% is our deficit estimates for this year and next year.
Okay. It's just that the Ukraine war is now imposing more demands. But okay, with that, let me come to China. Your report was surprising and a little scary. Can you tell us exactly how much of a deflationary force China is? I believe they've been cutting global export good prices.
So China is definitely going to be a deflationary force to reckon with. We are seeing that right now export prices in dollar terms are in deflation. China's non-commodities PPI index is also in deep deflation. And so these aggregate numbers are definitely indicating that. But if you look at even from a sectoral perspective, what we're seeing is that China has already been sort of deflationary for some of the large items, low value-added exports like durable goods, white goods. But at the margin, where we are seeing greater pressure is the new energy transition-related goods, which is electric vehicles, lithium batteries, solar panels, and even old generation chips, which is not in the new energy transition related sectors, but outside of that, it's a big component. When you look at the semiconductor sales, 40% is in this old generation chips, and China is actually exerting downward pressure in that segment as well. So it's quite wide-based export segments which are seeing deflationary pressures from China. And we think to the extent to which the policy narrative right now is that we want to do the restructuring in property sector, we want to do restructuring in the local government balance sheet, but we want to focus on good sources of growth, and that is manufacturing investment. And so to that extent, that the government is still driving that top-down approach to push for manufacturing investments, even while they have the excess capacities, we have to be watchful of competitive and deflationary pressure that China will send to the rest of the world.
Okay. You present in your report that if China continues to capture markets because of price undercutting, it might lead to, import tariffs being imposed, especially if the Republicans came to power in the US. Now, tell me a scenario first, whether you see major trade disruption if the Republicans came to power.
Yeah, I think that threat is very serious, and we are mindful of that. We've seen that in the previous administration, whatever President Trump, when he was there, whatever he indicated, he actually did follow up with actions. So we are quite taking this threat seriously. Okay. So if President Trump does get reelected, we have to be prepared for that outcome where they would be implementing tariffs. And there are two numbers that we are seeing in the media. Number one is that there would be 60% tariff on all imports from China and 10% tariff from all imports by the US, which includes every other country in the world. Okay. And we think both of these will be negative for the region. But if you have tariffs just focus on China, then some of the countries may have an offset in form of being a beneficiary of supply chain diversification, which will include India. Okay. But it will be Korea, India, Vietnam. Okay. We will be the beneficiaries. Okay.
No, but even assuming, let's keep Republicans out of this discussion. If China is such a deflationary force, where does that leave India actually? Is it that for instance, we already hear Indian steel companies are pretty worried about this deflationary impact of China. How will the RBI react, for instance? Because we still have high food inflation. The last number we got was 8.3% food inflation, although core is falling, partly because of factors like China. Where does this leave the Reserve Bank? They're faced with this deflation, but you can't cut because your headline inflation is not 4.
So RBI, Lata, we've debated this probably in the previous sessions on your show. It is focused on headline. I think there is no going back on that. So RBI will have to look at the headline inflation. If food inflation is persistently staying high, RBI will have to look at that. So there is no debate on that front. Now, as far as India's overall implication out of China's deflationary pressures is concerned, I think it is on a macro level beneficial. Of course, there will be some sectors which will be negatively exposed. But to the extent to which, India has its own domestic demand-driven strength, if you get this deflationary pressures from China that keeps core goods inflation within CPI somewhat low, and gives you an overall CPI outcome which is better and gets you closer to RBI's goal of 4%, I think it's net beneficiary. It's a challenge for countries which are more dependent on trade and exports as a growth driver. And then those companies, and that will have a negative macro effect for those economies. But for India, we think that there are other drivers to growth other than trade, and these competitive pressures will be less challenging.
So your equity analysts are not worried that cheaper Chinese steel may impact margins here. You know, some time back there was this huge fear. Toys, chemicals, pharmaceuticals, steel, everything coming from China was a threat and dampening Indian margins. No such fear this time.
Well, I think at the margin, it is not as bad as 2015-16 when you had China's PPI at -5.5%. But it's definitely, as I said, going to be negative for some sectors. But at an aggregate level, we are less worried about India's macro implications.
Okay, well, a final question on India's growth. Even Somanathan, the finance secretary, when I spoke to him, is not betting on 7, though the RBI said the number 7. What's your sense? Can there be a fear that growth has not broadened at the bottom of the pyramid? There are economists who point out urban demand is already slowing a bit, or at least not rising. As well, the PLFS, the labor force survey, indicates that jobs are increasing only in unpaid family labor, but not in salaried at the pace that one would like. So will this lack of broadening of the pyramid stymie India's growth pace?
Well, Lata, I think we are seeing that sign of broadening. There are two debates on this broadening story. One is when will the consumption trend broaden from urban to rural? And similarly on investment, when will it broaden from public to private? Whereas if you see the signs in the marginal data points, we think both those trends are already beginning to emerge. So for the consumer goods spending, the feel that we get that the rural sales is not doing well is because of the price cuts. They had done the price hikes earlier, then there is price cut. But if you look at the volume numbers, even for this December quarter, it looks like we have 5-6% real volume growth in rural economy, and that was contracting earlier. So there's a clear trend that rural consumption is improving, even for items like FMCG products. And similarly, if you look at two-wheeler sales volume, our analyst tells me that that volume growth that we are seeing in two-wheeler sales is also happening because of rural demand improving. So we are seeing that broadening out. It's just happening.
Okay.
And one other thing that I would like to highlight is that when we are thinking about rural consumption and broadening out of consumption, this cycle will be similar to what happened in 2003 to 7, where initially it was capex that was picking up and consumption was lagging. And within consumption, the urban consumption started to do well, and then rural consumption was picking up. Because as such, understand that the rural economy does not have any big indigenous source of income other than agriculture, which is growing at 3%. So it has to be the migration of rural workers to urban, and then them doing the transfers to the rural economy. And whatever is the government support in terms of redistribution spending. So the big driver tends to be the urban economy first, and then consumption.
Yeah, urban economy and the urban remittance, and perhaps that leading to an overflow of growth to rural areas. We are looking forward to that trend. Perhaps it will pick pace after elections. Thank you very much, Chetan Ahya, for joining us with a wealth of your analysis on US, China, and Asia.
Thank you.